Welcome back. This video is going to be an example of the fractal nature of trading models. I will do my best to articulate how you can interpret this, and I will transfer the knowledge in the best way I possibly can. My goal today is not to just make you understand that trading and setups and any type of model under the umbrella of ICT concepts is fractal, but price is also fractal, and I will show you how you can internalize that information to make it potent to your own trading. This is an example of the ICT 2022 model. It's where you have a liquidity pool, you sweep out an opposing liquidity pool, reverse, shows some strength to the upside, where we see a market structure shift, a fair value gap, and eventually the fair value gap provides a rally into the opposing liquidity, and then maybe even some targets above that level. What I'm going to present to you today is how we can look at this from an hourly time frame to derive a directional bias, and then using that information trade off of the lower time frames. So all we're going to do here is look at the hourly version of this 2022 model. Picture you in this market environment when this market structure shift occurs. So as this wick comes into that high and it engages this pool of liquidity, this engages a market structure shift. Why? Well, because we've already taken out sell side liquidity and we are looking higher to go into the relatively equal highs. Now, we do not need to predict where it's going to reverse. We just look for the signatures after it has already reversed to confirm that it's indeed going to trade higher into the relatively equal highs. So at this point here, when it runs higher, there's no market structure shift. The only thing we have is this little inversion fair value gap. It does hold and it does deliver, but this at that point in time would not have been strong enough for me. So when I see this breaker block, which is the low, high, lower, low, higher, high, the high in that series, the candle that makes the high, the entire candle is the breaker. The bodies of the price action stay above the middle of the breaker. So it doesn't go into this line here, which is the middle. It stays above. The wicks can go through. That's not a problem, as long as the bodies are closing above. And here we see as it trades into the middle, the bodies start compressing, and eventually we see a flat body, a doji candle. This is important because it's one of the signs that we can expect or anticipate a reversal, or that a PDRA can be respected. If we're bullish, we start to see it flatten out and it's above the middle. That's often a sign that we will turn and resume our bullish price delivery. Once we engage this high, we do not close through the market structure shift. That's another important distinction, because if we do not close through the market structure shift, often we are going to see a short-term discount reached for. So after we trade up above this high, it doesn't just continue blasting higher. It actually presents a bullish order block in the form of two down close candles. So it leaves this wick higher, then we see a down close candle, and then the subsequent candle makes a wick lower into this fair value gap, and then runs higher. How do we know it will use this fair value gap and not the upper one? Well, truthfully, we do not know that in real time. All we do is we wait and see which one it's going to use and which one it's showing reaction to. And this is an hourly time frame. We will break it down further on the lower time frame, because that is also where we derive a lot of narrative and understanding of where it will reverse from. Is it going to be the fair value gap, the lower one, or the higher one? Currently working on an hourly chart. We have limited information. When we drop down, it will become more obvious. But it does reject the fair value gap and then trade higher, closing above these two down close candles. That makes this a bullish order block. The following candlestick has a little bit of a tail, this wick right here, that goes down into these two up close candles, or these two down close candles, sorry, these black ones. Because this is a bullish order block, we know that it's an institutional price point, meaning that as smart money wants to see a buy side move, they are entering on these order blocks, on these down close candles. They're not entering at the lowest low, they're not entering at the highest high. They're scaling in as the position or as the move starts to present itself. That can be in inefficiencies, but it's primarily going to be through order blocks. When we are trending in one direction, we will see these retracements in the form of down close candles, And it's in these down close candles where we are seeing smart money in real time accumulate buy positions. So here, this is where banks, this is where hedge funds, anyone with extremely deep pockets who's trying to force in millions and millions of dollars into the marketplace, they have to enter in these two down close candles because they can't buy it as it's going higher. There's not enough people on the other end of their trades. But as it's going lower, there are a lot of sellers here. People are selling. The algorithm's offering low prices. People are taking those low prices. They're selling. And then who's on the opposite end of that? It's smart money. Anyone who's in with the idea that they're expecting it to go higher, but they can't enter as it's going higher because they're not trading with one contract. They're trading with thousands of contracts. So they have to buy it as it's going down here. Once it trades back down into that order block, that's our first indication, or rather our second indication after the fair value gap. But post market structure shift being above this high, that is the first indication that it will continue to deliver higher through into the relative weaker highs. So this is the ideal entry, the perfect entry, if you will, other than the fair value gap. So once this wick goes down into the order block, that would be a potential entry. Your stop loss would go slightly below this low. I would put it a little bit below the consequent encroachment of this fair value gap because this is an intermediate term low and it should not be taken once we've seen the market structure shift and a bullish order block in such a manner. And then eventually within the next couple of candlesticks, we see a larger move to the buy side and it takes out these relatively equal highs and it even gets a little bit more juice out of the lemon going into this fair value gap over here. If you've been through the core content, this you may know this as a liquidity void, but this is also known as a fair value gap. This is porous price action where it's delivering one-sidedly lower and there's not a lot of buying activity in this. So as it fills in or reaches into that inefficiency, it's filled in this bit of porous price action as well, and then it makes one little tiny run up into there, effectively rebalancing the extreme low on that fair value gap. One more poke and then we break into this consolidation and some bad price action. But here, this is where we're focusing our attention. Now this is the hourly time frame, and the reason we want to break down charts like this on a high time frame is because when we go into the lower time frame, we're not just seeing two candles to the downside here. We're seeing, say if we're on 15-minute chart, we'll see 8, and that gives us a lot more information. Each of these candles are going to be 4 candles on a 15-minute chart, so we have a lot more information to work with, but under the premise that on the higher time frame, this 2022 model is going to be delivering. So we, according to this model, say we're at the point of the market structure shift. We should be bullish now because it, as I mentioned earlier, didn't close through the market structure shift with a strong candle, it just wicked into it. We can expect a short-term discount. This is taught in the Silver Bullet Mentorship on this YouTube channel for free. Inside of that fair value gap, it rallies. Now, this on an hourly time frame only looks like, okay, he had one candle of opportunity. This is an hour of time in that fair value gap, and then there's the other hour where it trades into the order block. On a lower time frame, it looks like this. So this is the sell-side liquidity pool that the 2022 model sweeps over here. Then it actually does take out this low as well. That's 3 drives. If we're bullish and we see a 3 drives where we take out sell side, not once, this is once, but twice, that's 3 drives because we have 1 drive lower, 2 drives lower, 3 drives lower. So that can give us extra additional confluence to the idea of bullish price delivery occurring. Now this hourly breaker block that we looked at earlier on a 15-minute time frame is a lot larger. We can work to refine this, but for the purposes of this video and keeping it as simple as possible for the more beginner mindset, I will not do that and I will leave it as the hourly breaker block. We are still seeing that function where it's trading down into the breaker block, and here we start to see flatten out where the candles are not so big to the downside anymore. It's actually facing a lot more resistance. And then on the hourly time frame, what does that look like? It's the wicks being left in the lower half, the bodies are closing in the upper half. Back to the 15-minute time frame, we see that it's actually reached down into this 15-minute fair value gap before rallying higher. What does that tell us? that tells us something that we didn't see on the hourly time frame. On the hourly chart, all we're seeing is, okay, here's a breaker block, it's trading down into it, and it's going to run high. But on the 15-minute time frame, we have insight that we didn't have on the hourly time frame. Now, by using the same hourly principle, the same hourly PD rates, the same hourly narrative and model, we have more information to work with, but under the idea that that's the model that should be delivering, we'll see it react off of this 15-minute fair value gap and then start its run higher. Now, what would happen if you didn't know that this was undergoing on the hourly time frame yet, or on the 15-minute time frame yet? You were watching it, you were observing it, and you didn't quite see this. That's okay. You're not going to miss out on anything yet. You may miss out on someone else's trade where they enter right here and the breaker block is low and they get all the way into the relative legal highs. Don't worry about that. You're not trading for them, they're not trading for you. You have to look for the setups that jump out of the chart and they scream to you, I'm here, take me now. And for me, that isn't inside this fair value gap. And for you, it may not be. For you, it may be. If it is, amazing. If it isn't, this is where it probably is. It starts to run higher. Here's another fair value gap on the 15-minute chart that we didn't have on the hourly chart. But you may not be confident enough yet to buy because there hasn't been that hourly chart's market structure shift. So say we ignore any type of entry opportunity until that hourly candle meets into this high. That indicates, or that is the first tag on that market structure shift level. So because we didn't close through it in a strong way, we can anticipate that it will trade lower temporarily to grab a short-term discount. Short-term discount does not mean all the way into the lower half of the range, but just something reasonable where it can trade a little bit lower. This is some spooling, it creates more liquidity at the highs. It's also enabling smart money to enter, which, if we look back to the hourly time frame, that's these two down close candles, that's these order blocks. That's where smart money is entering, remember? So from here, it makes these couple of spikes lower, or it drops, and it drops down into the hourly fair value gap. And this doesn't look like a strong or a clean fair value gap on the 15-minute time frame. That's why it's important. We're not just working off of one time frame, we're using multiple. So I'm using the 1 hour to help me with the 15-minute, and I'm using the 15-minute to help me with the 1 hour. So they're both working in complementary fashion. It's not just hourly, 15-minute, 5-minute, 1 minute. It's hourly, 15-minute, 15-minute, 1 hour. They're all designed to work together. That's the fractal nature of price delivery. They are all delivering in tandem. The price action you see on this time frame right here is the same as the price action you see on this one, but this is represented in more candlesticks. There's a larger data set here that we can work with, but the pricing is the exact same. There's nothing changed. All of this order flow is still on the hourly time frame. It's just now we can see it in as smaller denominations. These candlesticks just denominate a smaller amount of time. So from this fair value gap now, we see the first rally off of the fair value gap. Now this is where, looking at the hourly chart, you would have seen this trade into that fair value gap and you could have potentially taken a buy. And that's where you should have been confident to take a buy because that is your 2022 model. But what if you weren't? What if you missed it? What if you weren't at the chart or you just were not confident enough to get into that position? No problem. This is why looking at this from a high time frame and then working lower is beneficial, because if you miss one entry here, you haven't missed the train. There's another bus that's going to take you to the rest of the setup. It may not be as good because your risk to reward ratio may not be as optimal, but the advantage is some more of the move has played out. You probably now have more conviction, more confidence in the fact that it should keep trading higher because you were a little bit scared to enter there. You didn't understand that it should reject super quickly, or maybe you were just hesitant or scared out of fear of losing to get in. But now that it's rallied, you're thinking, okay, I was right. I can trust this setup. No problem. Let's go back down to the 15-minute. It's rallied higher again, taken out this high, and then it trades down into this fair value gap right here, and then it rallies again. This is where you should take that trade. If you didn't take this buy setup, then you don't have a lot more time to work with, because now we're going quite far into the depths of the premium, and if you go and try and enter beyond this level here, beyond this fair value gap, now you're chasing price. This is what it looks like on a 15-minute time frame. But what does it look like on a 5-minute time frame? This is the 5-minute chart. Now we've gone quite a bit lower from the hourly. That's okay. So we began here on the hourly, now we're on the 5-minute. Does that make this any less likely to occur? No. You are trading the same price action. The same thing is happening on the 5-minute chart as it is on the hourly. The only difference is that you have more data to work with. So when it drops down into this fair value gap and it rejects, now, well, what we saw on the 15-minute was just it rejected and there's up close candles. On the 5-minute, we're seeing it a little bit differently. So now we're seeing this miniature little fair value gap was created. It's only a small one, but it is there. Then it trades down into it and then it runs higher. Not only does it run higher, it leaves these two fair value gaps completely open. That's a sign of strength. If we leave these inefficiencies in price and we're bullish and it's not trading down into them, that's a sign it's going to keep going in a fast manner. It's going to go quick. It's like rocket fuel. It's like pouring gasoline on a fire, where originally the fair value gap that is traded into is like pouring some, it's like throwing wood on it. It's going to light and it will go, but it's kind of slow. Whereas if you throw some petrol, it'll blow up and it'll go crazy. That's exactly what happens here. So with these are called breakaway gaps. We see a little bit of consolidation and then finally it starts to run and run and run and run and goes into those relative weak highs. Now, if you look at the difference between the 5-minute chart and the 15-minute chart, there's actually not many differences in the entry opportunities. It's just that the data is displayed a little bit differently. However, from the 15-minute chart, we have that entry opportunity and we have that fair value gap entry opportunity. On the 5-minute chart, we have the fair value gap. We have this secondary fair value gap. We have this fair value gap entry. But what if you weren't present on your chart for that? Well, then you had this one where it traded up, it came down, took the low, and then it went into this fair value gap, and then it rallied again. Then we had this order block. Then we had this order block. And we had these breakaway gaps. Now, would I recommend entering anywhere after this second fair value gap? No, because then you're chasing price. But the idea is still being represented there. You're still seeing that from the higher time frame perspective, all we did was look at this market structure shift. And then we framed two possible entries. The fair value gap, the order block. Not looking at anything else. This is from an hourly perspective. On the 15-minute chart, but now not only the order block, the fair value gap, so there's three. On the 5-minute, there's another one. What if we go down to the 1-minute chart? This right here is a very zoomed out version of the 1-minute chart. The reason I have to zoom out so much is because you won't see the full price action if I zoom in like I want to. But from here we have the higher time frame market structure shift. And then we go lower into this fair value gap. And now let's break down the price action inside this fair value gap. So on the 5-minute chart, we looked at the small fair value gap and it trades down into it and then it runs higher. On this chart, there really isn't anything significant of a fair value gap. This is a 1-minute chart, there isn't really a good one. On the 5-minute, that was there though. So you could have entered on the 5-minute there. But once it trades up, this is a V-shaped reversal outside of this fair value gap. So it trades down into it, to this fair value gap here, then it runs higher, and it's like this little V. These are, you're going to see in price, the reversals that come cleanest, that deliver the strongest, most amazing moves, come with these little V-shaped bottoms, where it runs lower into some kind of high time frame array, and then it turns with a lot of strength, and it's like a V-shape. Here, there is displacement here. Bit of consolidation, and then every single fair value gap is a breakaway gap. This one's a breakaway gap. This one's a breakaway gap. This one's a breakaway gap. Breakaway gap just means there's no entry given. It trades down into it. Oh, sorry, it doesn't trade down into it and just left open. So all of these over here, these all are left open. All of them. Then we see this consolidation. It raids the consolidation once, and then it raids it again for a second time. This is 9:30, so there's a lot of manipulation around this time. That's the 3 drives, and then it goes higher. Fair value gap, trades down into this institutional for entry drill. This is a high resistance liquidity run condition, but it still delivers, not in a pretty way, but it does deliver. So here now there's a lot of entry opportunities. this fair value gap, this order block, this order block, this fair value gap, this order block, this inversion fair value gap, this breaker block, this fair value gap, this order block, this order block. And because we're on a 1 minute chart, looking at this from the entire hourly perspective is no longer necessary. We don't need to look at it like this and frame our entry opportunities only looking for an entry in the discount. Because if we were only looking for an entry in the discount, the only thing we would have is this, a couple ticks. I mean, it is perfect precision, but you would have had to have a perfect precision entry if you limited yourself there. So rather than looking at the entire hourly perspective move, we can look at the 1 minute perspective. And the 1 minute perspective is the move begins from this V-shaped reversal. The move begins from that reversal outside of this fair value gap. So once we trade down into it, on a 1 minute chart, that's where the move begins. That's where I see this move begin. That's where sell side liquidity is rated. That's where we trade down into a 15-minute fair value gap. That's where our narrative is likely to be met. Our narrative is being met. So from here, now we only want to traditionally enter inside of the discount. We have every opportunity from this fair value gap going higher off these breakaway gaps, the stop run on this consolidation, the second stop run, 2 drives, and then we have this fair value gap, this order block, this order block, this fair value gap, this order block, and this order block. So there's a lot of entry opportunities, and all this is breaking down price from a 1 hour perspective over here to a 15-minute chart perspective over here, 5-minute chart like this, and then the 1 minute chart. And then not only do we go down, we go back up. Because when you're looking at this on a 1 minute chart, when it's trading down into this fair value gap, this is good, this is great. I'm not going to say it isn't, but you also want to look at the other time frames, the 5 minute. How is it trading on the 5 minute? Because if it's slow and lethargic here, you may be getting tricked on the 1 minute to thinking it's really fast delivery, but it isn't. This is fast delivery on a 5 minute chart. Trades down into this fair value gap, like so. If you're looking at this as an inversion range, you can look at this as an inversion fair value gap singularly. There's a whole bunch of PDRAs that you can use at your disposal, and that's what you want to use. I like fair value gaps and order blocks and breaker blocks. You may like only order blocks, and that's all you ever use. Okay, that is it for today's lecture on the fractal nature of trading models. If you would like to continue seeing more content like this, please leave a like on the channel. It's free, it costs you absolutely nothing, and it does benefit this channel a lot. But thank you for your interest, and I'll see you in the next lecture. If you are interested in more education, I have a private mentorship in the description of this video, and I also have a free mentorship on my YouTube channel labeled as the Silver Bullet Mentorship under the courses section. It's completely free. I have students that are profitable just from using that mentorship alone. They've never even been through ICT content. They only went through that mentorship and they trade profitably today, passing funding accounts, getting paid. The choice is yours. Thank you for watching.